Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 6, 2023. It's 2:55 p.m. as I'm starting the video, so late session update. I'll try to keep it brief, so see if I can get out to you by the close. Let me just keep it, to do that, I'll keep it limited to the big three. If I can somehow breeze through what I want to cover very quickly, maybe do some updates on some of the other things, that I've covered recently. Wheat still looking good. Natural gas took out both stops that I gave you yesterday. I had too tight. You want to keep them tight on that one because it's in a downtrend. So that really, it's gone. Plus, it never triggered that next buy signal going above that level I mentioned yesterday. But all right, let me start out here with QQQ. We'll look at treasuries and currencies, primarily the euro-US dollar pair, and then we'll see if we can get everything I want to cover. All right, so this is QQQ on a 60-minute time frame. If I don't mention it, time frames are usually up here in the top of the chart. You can see 1 hour highlighted there, 1H in blue, or you can see QQQ hourly. That's where it's going to show the time frame. Sometimes I neglect to mention what I'm talking on here. All right, this is the most recent divergent high. Just like you had a divergent high here, you had one right there, and you had a divergent low there, and that's how it works. And so kind of zooming in, we're still, it's more of a sideways move. This is what I look at if I were to turn off all the lines, but you can do it this way. This is pretty good support right here, right now at about 386.61. It's a level I've had here for a while. Remember, it's this gap. You have this gap right here from early, about the second week of November right there. And then we back tested it, and that remains a pretty important level. Once that gap goes, we'll probably backfill it, and that means come down to this level here. I have a very minor support, about 380.72. So overall, the near term, very, very, very short-term trend. If you zoom in just from this point, we're zigzagging down. Go out a little further than that, it's bullish. But then if you look at kind of just turn off all the lines and see for the last months, really since July, we peaked. We're trading exactly now. You can see my crosshairs follow the line over. We're right where we were when the Qs peaked back in July. And as I've mentioned, when you look at the equal weighteds, you have, this is not the equal weighted, this is SPY. SPY is about right there, a little lower than that level. And then you go to things like QQQE, still well below its July highs. RSP, the equal weighted. Again, the story is, and everybody knows it, it's the same, handful of Magnificent Seven stocks sucking in all the money that have lifted the indexes higher. And that's why that's evidenced in the equal weighteds lagging. And when you look at the equal weighted, here's RSP. I'm just on the 60-minute chart. I didn't mean to do this. The divergences to me are glaring. They're pretty darn strong, and they indicate, sooner than later, seasonality notwithstanding. We have, of course, the whole Santa rally they talk about in December and year-end stuff like that, window dressing. But either way, that's what I'm seeing. Let me go back to QQQ. So to kind of get a little micro analysis, we were here the other day, and I said, any pushback to backfill this gap right here, so the top of the gap would be an objective short entry, and that's what they gave you today. So if you took advantage of this morning's rip, I think the Qs were up over 1%. We're down 0.25% now. So that rally to backfill the gap today right here, you can see this is a 5-minute chart I just toggled to. There's the big old gap, and they stepped in and faded it pretty good to the tune of about over 1%. All right, back to the 60. All right, so now where do we go from here? We still have this uptrend line. I've been working off this board. Remember, I have two boards that I've showed you, but this is the trend line that now has quite a few more reactions. I started pointing this out the other day, even as we're coming down to it. We hit it, and that reaction there, that first reaction after these initial reactions here helped to validate it. And you can see over the last few days, that's what we're dancing on. We've been hugging this trend line. So a break of that, then you do have the 380, 361-ish support level, which could come into play again. And if and when that's taken out, that's pretty good because there's a thin zone. You can see it. Well, here's what I'm talking about. I like to keep a volume up price histogram on my chart. That shows you where all the trades have occurred recently, especially if you zoom in here. And you can see as I turn up these lines, this is the thin zone. Thin zones, you're always going to have a thin zone on a gap because there are no trades. See, there's no histogram bars right there as well. That's the gap right there. And so what that says is nobody bought in that level. There's that one little spike down here, but again, it's represented by a small histogram bar. And so that's how it works. So thin zones, whether it's a gap or just very few trades that occurred, you tend to get a relatively swift move down, like a gap backfill or not. So that's what I'm looking for. And bulls don't want to see that. That's just, if you're taking the other side of this, I always say I think you can find value in my analysis if you're on one side of the trade and I'm on the other, and you're right and I'm wrong, because I will highlight key support levels. So if you're a bull, you want to buy pullbacks to that level. If you're a bull, you want to buy a pullback to 380. 361. If you're a bull but you think there's going to be a little bit deeper drop and then a rally up, then you want to buy a backfill of the gap. And you don't want to wait till 378.51 or whatever the exact top is. You might want to step in a little bit before that, because all eyes, traders love these gaps. And so, if someone's plan is to short a gap backfill and then turn around and cover it, at least me, I'm not going to wait for 378.51. I'd rather miss the turn by a few points. So, because when it comes, it can come pretty fast. So I tend to cover my shorts slightly above the actual resistance level, and or go into my longs a little bit above, support, and or go long a little above that support. But that's near-term stuff. And, and then the way it works is, they should, quote unquote, I'm using my little fingers there with the little quotation marks, they quote unquote should step in and buy the gap, the backfill the gap. And they probably will the initial one. But if they don't, whether they buy it and then it fails, or we just go right through there, that's bearish. That's going to be quite bearish. Obviously, it would be more bearish to just see us go through there like it's not even there. Something comes up, maybe some. It's funny, we continue to see the little by little, but the employment situation weakening, and that's being so far. We're still in that bad news is good news mode. Where when we're coming in, I'm seeing a trend of increasingly worse employment numbers. Nothing huge yet, but each time we come in below expectations, it seems the market is more apt to rally, because that helps to solidify the patient's going to get the heroin back, the patient that's in detox, which is the market. But let me move forward. Anyways, at some point that the economic situation, and remember, consumer spending is 2/3 of GDP. The Fed can do whatever they want. They cannot overpower a recession. You can just go back to whatever period you want and look at what the market did, including 2008, and what happens during a recession. So you'll get the easy money, and the markets will react to it. But in the bigger picture, if and when the consumer rolls over, especially how they're so saddled with debt. And again, this is not a subjective observation by me. You can Google these charts are there. Macrotrends.net is a great source. There's a lot of them out there, and you can see all kinds of charts showing consumer debt, credit card debt, auto loans, whatever you want. It's all there. And we are... I'm going to get to a chart in a minute. It makes me laugh. But hold on. When I get to the Treasury yields and mortgage rates in a minute, I think I'm going to show you something that I believe is pretty compelling. Okay, so that's that. This is it. Let's not think too much more of it. Take it, leave it. This is also was T1. This is my other board on QQQ. T1 meaning first target that was hit. Gave you an opportunity. Quick traders, it's nothing big. Little pullback trades. Only a 60-minute chart. Game the bounce. Rallied up here, and now we need to take T1. We've already had the initial tag, so I think the next time we come down to it, it increases the odds that we'll break it, and then T2 is the bottom of that gap. So again, it's just a different board. Alrighty, so that's QQQ. Probably mentioned SPY, why not? SPY just continues to kind of diverge up, put in a divergent high. And like QQQ, it has a similar, not exact, but a comparable, it's really a trading range. You don't have, well, there's a gap down here, but this is the recent trading range. So we need to break below that. I know this is a busy board. I have a lot of lines, and I'm still looking for quite likely at minimum a back test of those primary downtrend lines that were broken. Those are the downtrend lines off the July highs, and even in the S&P, if and when we get there, that's a good 5%. On QQQ, it would be if and when we get there. Again, I'm just measuring, and what I'm doing is I'm measuring from the starting point here, but I'm pulling. You have to go to the right, and you'd have to do it a little more, because you're not going to fall there in one day. That would be a 5.5%. Right now, about a 5.35. And if you hit it over here, and that tells me on the crosshairs that would be on Wednesday the 20th of December, then that would be a 6% drop. So you remember, trend lines are dynamic. They change every single day, whether it's a downtrend line or an uptrend line where the price levels are. Okay, so that's it. Just kind of waiting for a crack of that trend line, give us our next sell signal. That kind of dovetails a little bit with Apple. I just got that chart out to you. Saw the cheerleaders coming out on in the media talking about the 3 trillion market cap again. We'll see if it pans out. I'm just having fun with this one so far. That's certainly been the case. I gave you that chart. I gave it to you last time back in late July, or in July when it first happened. There's a busy board here, but that was right here. And we went from there. That's exactly when it crossed, and so we were there for, again, fraction basis points or a percent or two higher, and then we peaked right there, and then it was followed by, I think, a 16% drop. And I'm still calling for a 1/3, or Apple to lose a third or half of its value over the next, well, back then I said 6 months. We're not there yet. I still have time. My 6-month call would put us out here. What is that? That'd be towards the end of January. So it's be one ugly drop, because this is where I think we're going down here. So anyways, that's it. And that was the first time it crossed there. There's different, they keep changing their float with all their buyback programs. That might be why, I don't know if the values are high. But I Googled, searched the headlines when I did this. This is where they first became a $2 trillion company. First time they became a $3 trillion. Then it was a kiss of death then. $3 trillion again. I told you I was on vacation, watching one of my in-laws who was, glued to CNBC all day, croning about Apple and, how it's just going to keep going up. And that was, of course, it's a kiss of death anyway. So we'll see if it happens again. I'm just having fun with that post, with that whole insanity, repeating the same behavior and expecting different results quote. We'll see. But again, then I try to give you factual stuff. It's fun to write those headlines and play with the puns and all that. And but these are the hard facts. That's a 60-minute chart of Apple right here that I gave you. And there's the comparable, when I say comparable to QQQ uptrend line right there. Plenty of reactions to have it valid. Negative divergence. A little shelf of price support there. And I even gave you some targets at the arrow breaks if you're interested. And, and this one could push a little higher. Certainly, you have 197 is that previous high right here. So if we do that and we do it soon, then we would still have the divergence intact. But if we go much above there, then guess what? You don't have the divergence. Doesn't mean the stock can't reverse after that. It's just that quite often when you burn through divergences, it's pretty bullish and you keep going. But my thoughts. It's a short setup if you want to take it on the break of the trend line. And again, that's just the next sell signal. And that's more of a better timing indicator, the 60-minute chart. But I told you the other day, we have that bearish PPO crossover in play on the daily chart. Negative divergence on the daily, on the weekly as well. That's one board. There's the weekly. We put in a divergent high back here. Any equal or marginal new high anytime soon. Put my indicators back for you. You can see on Apple, these are my indicators, PPO and RSI at least. You can put up other indicators. I use other ones. The percentage above the 200-day moving average or 40-week moving average, that's what this is. This is how much the stock is trading above. And when it's right on there, you're on the 200-day moving average, and that's bullish. When Apple is below the 200-day, yes, I know it says 40-week right here, because this is a weekly chart. On a weekly chart, a 40-period EMA is the same as a 200-day moving average on the daily chart, because there are 5 days in a week. So 5 times 40 equals 200. And so, again, that's something you watch as well. But you can use this as divergence. It's bullish when you get bullish divergence on there. That one's not actually bullish divergence. We're making a higher low. But I'll use a lot of these other indicators, and you get the same thing, divergences or crossovers on key levels. And anywho, so that's Apple. And where Apple goes, the market goes. And I still have these longer term targets down here that are way below. And it's it's could play out. We could, like I said, carry up. We can break that 60-minute trend line and start going down before the end of the year. There's only a few weeks left. Or I could just as easily see this thing carrying up, trying to test or make a slightly higher high over those previous highs and then roll over. Who knows? But This isn't just kind of, well, it's going to do this. No, I gave you the levels. Boom, I didn't even set it yet, but let me go ahead and set an alert there. And that would be one thing. And if that happens, what I do is I look at the rest of the lot. When I'm talking about the rest of the lot, I mean the other Mag 7. I'll look at Microsoft. Where's Microsoft? Here's a trend line, and it's a little bit healthier above its trend line. It's a pretty good trend line, a lot of reactions there. So a little, one after another. When these break, Alphabet, that's a sloppy chart. But, I go to the daily and the weeklies, and they're all singing the same song. They all put in these big divergent highs, and which I still maintain and have all along. That's probably the peak in the market as a whole. Individual stocks, sometimes you're going to have some that make new highs and not the rest. So I'm looking at everything collectively. And all right, let's just jump over to the euro, and then I'll wrap with the treasuries. All right, so again, talking about the big three, there's a couple things. Please don't let me forget. I'm talking to myself, obviously, but I don't want to forget to show you we'll do it next when I lead into treasuries. That disconnect. Remember what I've been looking for? Remember I've been uber bullish on bonds for a while, right off the lows recently, and said, you know what? Even though, there's been that high correlation, very, very strong. I'm going to show it to you in a second. I think we may start to see that disconnect, and we're point where bonds can continue to go up, rates can continue to fall, but yet instead of that being bullish for stocks may start going the other way. I'm starting to see some early signs. I have to be cautious. You know me. I'm always saying that one day doesn't make a trend, but guess what? 2 days, 3 days, 4. At some point, a series of days strung together, or in a short period, start to make a trend. Okay, and that's what I'm going to show you here in a second. But boom, there it is. Euro is now at my next target. Remember, I had given you this up here when we were in the wedge, saying I expect to break down this. It would be a sell signal in the euro. And if you missed it, or you live on another planet, I've told you many, many times, there is an unmistakable correlation between the stock market and the currencies. I just turned on with the blue and the white lines, QQQ and SPY. Obviously, those two move together, and you can see here they're moving in lockstep. I mean, literally almost perfect lockstep with the market. So you got to zoom in here. It gets a little messy, and usually what you want to do is, if you're going to do it this way, use FXE or UUP. UUP is the upside down dollar, and you can see that that correlation there. It's actually even better with FXE. So that's why I like to use EUR USD. So look at that perfect correlation with the euro going up and down. And why did I use FXE? Because it's trading in the same time period versus EUR USD. The FXE is an ETN, so it's going to trade 9:30 to 4 p.m., just like QQQ and SPY. And you can see, again, the impact that the drop in the euro that we called for here has had on the markets. Not as much as I would have thought so far. You can see there is some, not divergence. They are moving down. They have both peaked here, but they're not falling nearly as much as they usually do. And sometimes you get that where they kind of ignore, and then one or the other gets a memo. Now, let me just jump back. Let me turn off these comparisons. Go back here, and I have to say we are at that next target. And the reason I list multiple targets is that the initial tag of each one usually produces a reaction. We hit that one that day. I pointed it out. And then I gave you this purple level here in real time, saying that would be my likely bounce target zone, where you can add to shorts on the market or short on the euro. And we hit the very bottom of it. And then we continued the downtrend. Then we went on. We took out that 108 support or target. And now we're coming up on the next one here. So we're doing that with positive divergence, so it's hard to get uber bearish right now unless we break through there, and that's a possibility. I just want to point that out. If you're short the euro or long the dollar or equities, I'm just kind of sitting. I'm morphed. You know this. I've kind of morphed into swing trading mode with those index shorts with small positions that I'm going to hold or build to, giving some room here, because it appears to me, based on everything else I've covered time and time again, including some of the recent sell signals like the PPO bearish crossover on the Qs and some other things, that that there's enough evidence to me to be short. The risk reward favors, I believe, being short than long right now. But we'll watch this. And then when I look at the daily chart, there's also this support right here at about 1076 on the euro right there that I have. And a pretty decent one, not super great. But here's where I think we're going before all said and done. And we could just pop right through that support. There's this uptrend line right here. And so if we can, whether it's now, whether we get a reaction or not, we break that, probably go down here. And that would bring us, if we do, that'll probably take QQQ down below that trend line. Oh, almost certainly take it down below that trend line and give us some more downside there. Maybe even be the catalyst to backtest those the downtrend lines on the indexes on SPY and QQQ off the July highs. We'll see. But I did want to point it out. You got to be a little cautious right now because we do have the euro at finally that support or next target. With some divergences in place. Also, keep in mind too, and that's why I'm acknowledging this. But remember, we're also coming up off a much larger negative divergence and divergent high right there. And so sometimes early on, after a wedge break like that, you start to set up some bullish divergence, and it gets taken out. But that's it. So if I had to flip a coin, I'd bet at least a little reaction off here. Would be my guess. And if we break it and broken support, especially if the divergences get taken out here because we move lower down below these previous troughs, then that's going to open the door for a deeper move down in the euro, which again, as I just showed you, will most likely bring stocks down. Okay, on to the next one, treasuries. TLT, T4 zone hit. Now is this 95-ish price resistance zone. It runs from about 95 at about, you can see the numbers, 95.08 up to 95.69, and that was hit, and we're there. And the divergence, same chart I just moved the lines a hair. We went up a slightly higher, and this is favors a odds favor reaction. And at minimum, here's your uptrend line. So for those of you that might want to reverse, close out the long and reverse to a short, that'd be a minimum target. I don't even know if it's worth it. It's a couple percent. Maybe 2%. I don't know what it is to that. You can measure it. But if that breaks, this is, I think, a likely target. And I posted that for somebody on the after the chart I got out to you this morning. That's about 89.65. And just based on the scope of this divergence and that trend line, I think that's a very likely target. And it would be to try to measure it for you. If hit, that's about 6.5% drop in TLT. So you could use a stop. I think I even provided that for in that comment that I put under there. That's right there at about 97, a little bit above 97, that reaction high. You have some more reactions here. I think that's a good stop loss right up here if you're trying to swing down for a pullback trade. If this happens, and let me get to that chart I wanted to show you here a second ago. Let me do this. Let's turn off the lines. We'll leave it on TLT. And let's take a look at the mark. We could do SPY, or let's just do QQQ. It's got a little more juice in it, and overlay it. Okay. So here is that hypersensitivity. Now look at these lines here. Don't look at where they begin. If I set them to start at the same point, we can do that. But remember, I always point this out. The stock market, especially QQQ, moves a lot more up and down in percentage terms than treasury bonds. That's why that treasury bond trade we just closed out was a, what did I say, 16% gain, but really a 28% or 32, whatever it was, double, because it was a double weighted suggested position size, being due to the inherently low volatility and lower risk in treasury bonds. But you can see when you start them at the same point, they drift so far apart, it really makes it hard to do the comparison. So I turn that off, and all you have to do when you're doing a comparison is just look at the inflection points. Look at, are they both moving up or down at the same time? When they both bottom, do they both bottom around the same time? And so you can see the relationship. So this was bonds going up, and this was that whole big correction we just had off the July highs. And this is really where, remember, this is where it got, where I told you it would, and it did, where stocks became hypersensitive, because that was the breakout. We broke out above the previous multi-year highs, and treasury bond yields were moving up, and that means treasury bonds were going down. Remember, these are the bond prices. So this was the breakout, and bond yields spiking to new multi-year highs. which took the stock market right here. You can see it took QQQ down with it. Again, it's nothing, it's here, it's not in percentage terms. That was a big drop in QQQ at the time. And so what I wanted to show you is since then, this is the point I'm trying to make, they had an extreme correlation, very high. Look at that, tick by tick, almost a perfect mirror of each other, the rips, the dips, because stocks were hypersensitive. And then what I told you I'd be looking for, and I expected, and I'm starting to get a little early signs of it. Again, one day doesn't make a trend, but we've had a few days here where you can see now, and today is another good day, and this is like the third day I think this week I've seen it. Here we are, TLT is up 1.24% right now as I do this video live, and QQQ is down 0.7. That is unusual. That is that kind of what I called handoff, or starting to see these things part, where the stock market is no longer responding tick by tick. And keep in mind, guys, that's with Treasuries just now hitting a multi-week high, or even multi-month high in prices, which means a drop in yields. Yields just hit a multi-week or multi-month low, and yet the stock market's down, and it's down not just one day today, because that again wouldn't make a trend, but as I showed you earlier in the video, QQQ peaked back. Let me turn off the, just want to show you that correlation. So before I leave this chart, just so you can see it here. So this is QQQ, and it's been moving lower, as I showed you earlier on the 60-minute chart. I can show it to you here on this line chart, yet Treasuries continue to go up. So now what do you think is going to happen if I'm right in TLT, now that it's hit my fourth and final near-term swing target, and we correct, even if it's a 6% correction, which is a big drop in Treasuries, and that's Treasury bond prices. So it would be a significant pullback or spike in yields. If stocks are already doing this, I find it very hard to imagine they're going to go up or even hold up. They're probably going to react pretty good to it. So now I can't guarantee the pullback in TLT, but it is my most likely scenario for all the reasons I stated. And a lot of Treasury bonds at resistance, trendline resistance, and it's not just the 30-year. I look at the 10-year. This is IEF. Same thing with IEF, the 10-year bond ETF, 7 to 10 year negative divergence. I look at the daily chart. This is a daily chart. A lot of lines here, but let me just highlight the most salient. This is a downtrend line right here. It starts back in November of October. It starts right around the time the stock market bottomed. And there's that downtrend line. So the 10-year, which is considered by most the most important Treasury bond to watch, 30-year mortgages are most closely tracked to the 10-year Treasury bond. It's at resistance as well. So there's, I feel strong. I'm short Treasuries as of this morning. We hit that level. Short equities as well. And there it is for you. One other thing I'm going to show you on this chart. I was going to go over each and every one. I can show you the yields. The yields are just the bonds in reverse. You can go to TNX, 10-year yield. There's a busy board here. Here's a little bit cleaner board. You can see the trend line I have right here. So there's your uptrend line with the 10-year at this uptrend line right there. And a couple things. So why we're here on the 10-year, let me say that. I'm going to show you two more charts, and then I'll try to get this out to you. And I find this, I don't know, let's just say cool. I won't say baffling because I get it. I get how the financial markets work. I've done this long enough. It's not about, and there's always a big disconnect between the stock market and the economy. The two do not marry each other. But what the stock market does, it's forward-looking. So it's more concerned about where things are going than where their actually current conditions are. But let me show you something real quickly here. The stock market, and you can look at SPY, S&P 500, which I just put it on. This is a daily chart. Or QQQ. I think we all know this. They both bottomed right there in mid-October. That was the end of the what I consider initial leg down in a bear market with another leg still to come. And others think that was a bear market that's over and we're in a new bull market. Doesn't matter. You can argue about that all day long. That's not relevant right now. Just let's all agree that was a significant bottom October of 2022. Same thing with QQQ, right? There. And then had an almost near bottom there in January, and that's where it took off. Okay, so we know that to be the case. That's not debatable. Where were yields back then? This was, and what was the big reason for that big drop in the stock market. It was rising real yields. It was the inflation trade. It was inflation that was driving the yields up. And again, it was the expectation that it was going to continue. So it pushed yields, this is the 10-year, to multi-year highs. It pushed it to yields to levels not seen since 2007, 2008, just at the time of the last real recession and real bear market. And they call it the Great Recession back then. And okay, so that was right there. There was the bottom of the stock market. The stock market, let me just jump back to it. SPY rally, the S&P I think was up 30%. I'm just going to measure it here. I just toggled back. I'm just going to take a line parallel to that roughly and measure up to the highs. Yeah, 30, 31, 30%, call it. QQQ was better than 50. I'm going to just take this again, use my measuring tool. I know this is a busy board, forgive me. 54%. Okay, so 30% on the S&P, 54. We know that was mostly attributed to the FANGs, but it doesn't matter. Those are the stats. So let me get back to my yield. So this yields rising to this level were pretty much the sole contributing factor. I think everyone will agree was the worry of inflation, which that's because it makes price of goods go up. It makes interest rates go higher. So this was what brought the markets down to that point back in October of 2022. Here's where we're at today. We are almost, so this whole little rally, this is where, and this is why I said the markets would, and they did become hypersensitive, because anything above that, when we pulled back down, this was the big rally we had. This is what caused, when the markets saw that rates peaked and were going down, that is, again, 100% the fundamental cause cited, and everyone will agree, for the rally in equities that was 30% roughly in the S&P and over 50% in the NASDAQ 100. Okay, so now fundamental, if you just want to say, okay, well, this is where, if stocks were fairly valued back then in October at the lows, okay, and we're back to where we were. We're just a hair below that level right now. And so yet stocks are up over 50%, or were recently in the NASDAQ 100 and 30%. So that's not jiving. And so, and again, I preluded this whole conversation here by saying, yes, the markets are forward looking. So there is the vast consensus. The Fed futures with a near 100% certainty that the Fed's not only done hiking and is in pause mode, but they're actually going to be cutting soon. So that is the expectation. And guys, that may be the reality too. And that happens, then look, that's going to provide some juice. As long as there's no big shocks to the financial system, then that should be net bullish. However, if this happens, because I see a very, very one-sided trade now. We got long and bullish treasuries before the Fed last Fed meeting because the charts told me to, but everybody was bearish and now everybody's bullish. I've rarely seen sentiment on bonds, and I wish I had an accurate measure. I know you have on stocks, you have the AAII and these different surveys that are done weekly and show sentiment readings. But as far as bond traders go, and really the stock market, I can recall fewer times where I've seen such a drastic flop from uber bearish sentiment on bonds and rates and everything to uber bullish right now. Everybody and their brothers tripping over themselves to buy treasuries, which tells me we'll probably at least get a little check rally here. And so my point being, guys, if you look at it from a technical perspective, first of all, well, remember, rates are now just a hair below where they were when the market was down at one of the bottoms of one of the worst corrections or bear markets we've seen in years. Okay, so we're right there. And let's just say we bounce and the yields come up here. We're not far off a back test. And let me look at TYX. That's the 10-year right there. This is the 30-year. So if we bounce up here and we get back above there, that's a important threshold. So we're going to be watching this closely. I'm not sure where we're going to go. I also showed you already the disconnect, but the point is that I think we're already seeing stocks fall with bond yields continuing to drop into today, and yet the stock market's starting to already come down lately. What's going to happen if I'm right and bonds pull back in price and we see yields come back up a little bit, it won't take much, because again, I believe it's kind of a range, in my opinion, in this area here where bonds will remain stocks will remain hypersensitive to interest rates. So there's that. Consider that. One other chart I wanted to show you that kind of meshes with what I'm just showing you here is this one. Okay, we've seen everything, just about everything that was getting beat down. The things that were most distressed, there are certain things that are certain companies and sectors that are more sensitive to interest rates than others. For example, I mentioned the other day small caps. The small cap stocks as a whole are much more sensitive to interest rates than large caps because they are much more dependent on borrowing to continue their ongoing operations and any expansions. And that's, again, generally speaking, but very much so. So, it's not even a close thing. We know that banks and other things, and again, there's some dynamics to what the yield curve looks like, because their short-term cost, their cost to pay deposits versus, and the banks are being, they have a lifeline right now by the Fed. We all know that. But what I wanted to show you here is talk about mortgage rates real quick. This is the 30-year mortgage rate. And we saw, as expected, a big spike. And I look at Redfin, Zillow. I look at all these stats from different real estate markets around the country. And what we do know is the 30-year mortgage now, and it's interesting, guys, because remember, we've seen this pullback in the pullback in yields that I showed you a second on Treasuries, and I showed you that Treasuries fell back below that peak right here. There's the October low peak, but yet mortgage rates haven't. And the reason for that is because credit conditions tightened. So I think right now this market, I guess my takeaway is this market's priced for perfection. We saw a huge surge, and obviously there was a lot of pent-up demand for closings. There were a lot of homes. Remember, you have this massive shortage of inventory right now because nobody wants to put their house up for sale. Nobody wants to give up that 2.5%, 3% mortgage for a 7% or almost 8% mortgage where they peaked recently. They were close to 8%. You can see the rates right here. I just wanted to illustrate the point that as of now, we're close to, but not even down below. We're right basically where we were back then. So you had that surge because there's always that subset of people who have to move. They're being transferred for their job, or they couldn't afford their other house. They had to sell it. They downsized, or whatever reason. There's always some moving, and so they jumped all over that little abatement in yield. But they're no better off than they were. In fact, they're still today worse off than they were when the market peaked back here. Okay, so I just wanted to point that out, that because of tightening credit conditions, we have not seen the average 30-year drop below where it was back then. And so I guess, again, the takeaway is, yes, is this net bullish, the abatement in rates recently? Yeah, but all it's done is taken us back to where the stock market was back in October when it bottomed, and it is 100% pricing in that this is going to continue. Why? It has to be because equities, being at closer to their previous bull market highs, a lot closer to that than that October low. And so just try to imagine for 1 second if this doesn't happen and this does happen. What I think, again, it's something to watch. It evolves day by day. It's not going to happen overnight, but tick by tick, if yields start going up and mortgage rates start going up from here, I think you will see that return to hypersensitivity, and it's going to go the other way this time around because bond yields will be going up and stocks are not going to like it. All right, so that's that. And look, if you are a bull, this is possible. I've showed you there's trend lines that we're testing now on the 30-year and the 10-year that I showed you earlier, where I think we're going to reverse off of and see a pullback in bond prices, a little spike in yields. But if I'm wrong, we just slice right through there, and that's going to be, again, I like to say the word net bullish for the stock market. It doesn't guarantee bullishness because other things can happen. And as I showed you recently, one day or a week so far. It's been about a week. Doesn't make a trend, but I have seen that trend where yields continue to fall, and all of a sudden now it's not doing anything for stocks anymore. And again, maybe it's just a kind of a blip, a temporary disconnect, but we'll see. So those are the things to watch. I have enough time, I think, if I stop it here to get it out to you guys. Again, as I said in the beginning of the video, no change of what I covered yesterday on crude, natural gas, anything. Wheat still looks good. Natural gas blew right through that stop, and I had that stop. Remember, the lowest stop set above the recent lows, so that would have saved you for that big spike down today that happened. That's why I did that, because I figured if we got anywhere close to the lows, sometimes I'll put the stop on the other side of the low, but I didn't want to be in line with all those trades. So that one worked out. It was a losing trade, but it sidestepped a big drop. I think natural gas, I'm looking now, the futures are down 4.8%. But I'll be watching. It's getting closer to a bottom than anything, I'll tell you that. So, all right, guys, let me wrap up, get the video out to you, and I will look to see if I can dig up anything else. But I'm just kind of staying focused or hyper-focused on the big three right now: Treasuries, stocks, and the euro US dollar. This has been Randy Finney with Right Side of the Chart. Have a great day.